Hi, I'm Lee Fredrickson. Today I want to talk to you about sales and marketing strategy for accounting firms. And this is going to be the first of two presentations. We're going to cover two of the basic ones this time and two of them tomorrow. Today we're going to talk about the seller-doer strategy and the traditional seller strategy. So let's start first with seller-doer. This is a very familiar strategy to a lot of firms. It's one where the person who's making the sale is also the person who's doing the work. Very common, particularly in smaller firms or smaller practices, where the same person does both roles. Now there's some real advantages of this one because potential clients know who they're working with, and that's very important to a lot of clients. It also develops a lot of familiarity and trust during the sales process, so you understand the client and they're not having to go back over things that they've covered during the sales process. So a couple of really big advantages. Now there's a big disadvantage too, and that is it's the same person doing the work. So you get real busy doing work and your business development falls off. Then you get real busy doing business development, and then all of a sudden you can't do all the work. So you get this cycle going up and down with that one. That's a problem. One way to get around that is the traditional seller model. Now you see a lot this in particularly information technology and so forth. That's where there's a pretty complicated sales process and where the salesperson is responsible for generating the lead and closing the opportunity. They own that whole process, and the person who's doing the work only comes in when the sale is closed. That's when they get into there. The seller maintains, the person who's closing the sale, the salesperson, maintains an ongoing relationship. So you have an advantage of you have dedicated roles, and they're the different roles. They have two different people doing it, and that doesn't interfere so much with the person doing the work, so you don't have that up and down cycle. So that's definite advantages. However, there's a minimal opportunity for the doer to get to know the client or to get to know the situation during the sales process. So that sometimes creates a clunky transition. It also creates the problem of you've got two different people you have to pay for some of the overlap. So those are two of the four models. Next time we'll look at two remaining models to see which are most appropriate for accounting firms.